recording. All attendees are in listen-only mode.
Hi, good afternoon, everyone. Thank you all so much for joining us today. This is for our quarterly webinar series titled CIO's Corner, Quarterly Update with our Chief Investment Officer, Chris Gauthier. And for those of you joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth, and I've been with the firm for about 4.5 years now, and my primary role includes client service, marketing, and compliance. I do want to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit any of your questions throughout the course of the webinar. I will be monitoring them and will ask Chris to answer as many as he can at the end of the webinar. If we do happen to run low on time, Chris will reach out to you directly if we do not get to your question. Now, I would just like to introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He's responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda. And thank you, Amanda, for that wonderful introduction. And good afternoon, everyone. And thank you for joining me on this picture-perfect New England fall day here. Kind of reminds me a little bit of the third quarter, 2019. It really did look like this picture-perfect quarter from a performance standpoint and from the data standpoint, but with a little divergence. And we're going to talk a lot about this divergence that we're seeing. And really what it means to us is that you can't just look at the headlines. You really must go beyond the headlines and really look at the fine print, look at the underlying data to see what's really going on in the investment world. And we really think these divergences are happening. And the way I look at it and the way to visualize this, if you think about a duck on a pond, I'm sure living in New England and around the country, we've all seen ducks on a pond. You look at them, they're just floating around. It looks effortless, just going nice and calm. But if you would take a look underneath the water, you'd see these feet going like mad. And we really think that's what's happening. So with that, let's kind of take a look at what we're going to look at today and what it tells us about the current environment. So as always, we'll look at asset class performance over the past quarter. We'll look at the current investment environment from the fixed income, equity, economic, both domestic and global perspective. We'll see what that means for our risk model and finally close it out with what that indicates for our portfolio positioning and where investors should be positioned going forward. So taking a look at 3Q 2019, it really was, on the surface, a great time to be invested. You know, everything was pretty much positive. On the surface, things looked good, but taking a little bit deeper dive doesn't look as good as it really appears on the surface. There really was this flight to safety. And when we say flight to safety, that means people sold risk assets, or they're looking that the environment going forward doesn't look as strong as you think it is. So we look at the best performing asset class of the past quarter was long-term treasuries, up about 8%. The next one is gold. The next one is the dollar, then corporate bond. And you're seeing a theme here that it's really these fixed income, low volatility instruments, managed futures. Again, very good protection. Then we come to the S&P 500, and everybody says, well, that's the equity market. You know, it's a risk-on trade. But really, when we look at the risk assets that are highlighted in blue and green on this chart, S&P 500 is the one that only stands out on the positive side. Why is that? Well, given the rise of ETFs, the change in the market structure, S&P 500 had really become this safe asset. So when you see the S&P 500 up and you see things like over here in blue, small cap, international, emerging markets, traditional riskier assets down, let's call it divergence. Something's wrong. So again, it really was this big flight to safety. You can see that in this diversified portfolios that are highlighted in red. So we look here, conservative portfolio is up 1.66 in the quarter, moderate 1.05, and aggressive 0.63. Now, for those of you who have studied finance in any shape or form, you realize that's almost standing traditional finance theory on its head, that the more risk you have, the better the performance, especially in a market that's rising. So again, divergence. Things are looking a little bit different underneath the hood than what we get from the headlines. Over on the far right, you see oil was the worst performer in the quarter. Again, oil is just a mess, and we think it is uninvestable. It's a headline-driven asset class based on no fundamentals, but over the longer term, we do believe that it is headed downward. But again, trying to take advantage of that with these ups and downs and volatility is just an uninvestable asset. So taking a step back and expanding the time frame to 1 year, the story doesn't really change. You do see a nice positive skew to the left. Unfortunately, it's still led by long-term treasuries, still led by gold and the bonds, so the traditional safe asset classes are still leading the way over the past year. And when you kind of look down at the S&P, you'd see it's a very healthy 4%, but not when you have gold going up over 20% and long-term treasuries going up 25%. There's a diversion in performance. There's something in the market that's telling you something may be off here. There's something underneath the surface that we're not seeing given this headline performance. The one exception in the asset classes is the frontier markets. So again, that's in green, which means it's an international asset class. The frontier markets are, think about Vietnam, Morocco, the really markets that aren't even emerging yet. The best way to kind of describe it, and I've come up with many different ways, and the best one I've heard, and I wish I could take credit for it, but it wasn't me who came up with this. I heard it at a conference. But if you're talking about developed markets, then you can drink the water from the tap. If you're talking about emerging markets, you probably better be drinking a bottled water. And if you're talking about frontier markets, you better be drinking a Coke. So again, really down the developed scale, but again, offering that idiosyncratic risk that really helps performance. So for those of you who have spoken with us, who are clients of us, you know we're a big believer in factors. That it's one underpins one of the 5 pillars of our investment process. And what we're looking at here is U.S. equity factor performance over the past quarter. Just a cursory glance at this, and you can see it right away. There was something happened in August. That really was the Trump tweet fest. I don't know if you remember that at all, but it was the trade war was going great, the trade war was going horrible, backwards and forth, and you get this volatility. But again, still overall for the quarter, still up a very healthy 1.75 in the S&P, 1.72 on value, 0.9 in momentum. So again, headline looks good. Everything's up, except for the fact that when you're looking at factors and you look at the best performing factor, which is VYM, that stands for the Vanguard High Income Equity ETF. That's the safe part of the market. Those are the things that usually go up when people are scared. Think Procter & Gamble, utilities, things that they're not too excited about the equity market, they go into that. That's the best performing factor in this quarter. The worst performing factor was momentum, which is highlighted in purple here. Again, up 0.9, nothing to sneeze at. Always take positive performance. But again, the aggressive part of the factor universe, the one that's supposed to really rise up when you see a risk on trade happening, didn't behave like that. So again, even in this rising market, we saw this divergence in performance underneath the hood where the safer part of the markets, the ones that you don't expect to go up when you're bullish about the future environment, are leading the way. And that is never good for future performance, as we'll kind of see going forward. We'll look at some other charts. So that's kind of where we've been. So let's kind of look at where we are, and that'll help us understand where we may be going. So we're going to take a first look at fixed income. Fixed income begins with U.S. interest rates. What's the Fed doing? How are they positioned in their interest rates? And again, anybody who's listened to the news at all anywhere these days know that it's lower for longer. And this chart going back to 1999 kind of displays that. This is the Fed funds rate to the actual date right here, which is 1.88, which is where we're at now. And it's actually a range. It's never exactly that number. So it's 1.75 to like 1.9 and goes in that range. That's where we currently are. Looking at the future, these blue dots right here that are up and to the right is the Fed's year-end estimates based on the dot plot. The one down here that's declining is the market expectations. So again, even without any financial knowledge, something's happening here. There's a divergence, right? The Fed's saying we're going to raise rates over the next few years here, and the market's saying, well, I'm not seeing that. I really think rates should be lower for longer here, that we're missing something. Now, it could be markets talking their own book. You know, equity markets like lower rates. It helps risk assets. But overall, again, it's just one other example of a divergence happening in the marketplace, and we need to understand why that is happening. It is interesting to note that it's just not a U.S. problem. And again, I say problems. I do think rates could go up from here. But again, some people like lower rates. It's economic theory. We'll see what happens. But we're not alone in this. When we look across the pond and we look at Bank of England, they're at 75 basis points, so definitely lower than the U.S. The Bank of Japan, which is at negative 10 basis points, and they've been negative for a while. They had their own kind of individual issues going on, but they're joining the global party as lower to longer. And the ECB is at 0.00. So again, everybody's lower for longer. And this has to have implications across financial markets. And we're starting to see that really come through. One of the biggest things to me that something's wrong is global interest rates. So what are we looking at here? We're looking here at the left-hand side, negative yielding debt. That's the value of the global debt that's actually a negative yield. It's up almost $16 trillion. So let's just stop and see what this means here, because again, it's a really important and really need to understand what this means. Negative yielding debt doesn't sound too bad. But what you're essentially doing is think about loaning someone money in your own little world. You're loaning your brother, your sister, even your kids money. You may never get it back from your kids. Hopefully you get it back from your brother or sister, but you're loaning them money. And instead of them paying you interest, you're gonna pay them money. So you're gonna loan them $5 and say, okay, I'll give you 10 cents every week that you don't pay me back. So you're paying someone to take your money. And that's what's happening in negative yielding debt. So you're lending the Bank of England money for 2 years and you're paying them for the privilege of doing that. It just doesn't make sense, some divergence. Now, 16 trillion is a big number, but how big is it into the global bond market? That's what we have over here on the right, the breakdown of global government bond yields. So this dark blue is this chart on the left. So this 16 trillion is this blue. If you see right here, almost 30%. So again, just let that sink in for a moment. 30% of the global government bond market is actually trading at a negative yield. We've never seen this before. It's just unheard of. Again, the problem of having low rates for long out here and this adjustment to the financial and this actually, I don't want to be too mean here, but this experiment we're running through with the Fed, this has never been tried before. So we're really having an experiment. And these are some of the unintended consequences of having rates so low. When we look at this chart over here on the right still, you see the US 10-year at 1.68, one of the highest. So again, what I get from a lot of clients is, well, I still need income. US is at 1.68, got to be something better than that. And there's 20% out here of government debt trading above 1.68. Why don't we buy some of that? And my first thing, sure, you want to earn 13%? And the client says, yeah, 13% sounds good to me. Okay, we're lending money to Turkey. Well, Turkey's a little scary. Erdogan's invading Syria. We don't really want to invest with them. Why don't we go down a little bit lower? Okay, I can get you like 7%. I'm like, oh, I like that. Who are we going to lend to? Now we're lending to Brazil, Russia to get 7%. And even if we go down to the 3 to 4%, now we're lending to India, Colombia, the Philippines. Again, it just shows you how distorted this world is based on these lower rates for longer, and that it's telling you something that this cannot be sustainable, that there's something underneath the hood going on that could foretell poor performance going forward. So that's negative global interest rates. And the first thing is, well, why don't we just raise rates? And the answer is they don't have to. The Fed has a dual mandate, is full employment, which we are at, given the friction in the market that we're pretty much at full employment now, and stable prices. Now the Fed can decide what stable prices mean, and what they have decided is that stable prices is inflation 2% or under. So their target is 2%. So as long as inflation doesn't run away, they can justify lower rates for longer. And what we're looking at here is inflation going back to 1969, CPI and core CPI. The difference between the two is food and energy. So food and energy are included in CPI, not included in core CPI. The Fed looks at core CPI. Again, they say it's less volatile, but anybody who's ever lived, you need to have food and energy. So I'm not sure why they do that, but for whatever reason, they focus on core CPI, which is this brown line or dark gray line right here. We go over down here, we look at it, it's a little under 2%, or a little right around 2%. So again, looking at the headlines, everything is good, there's low inflation, we're gonna keep rates lower for longer. But if you look at the end here, it's a little hookup. So what is this telling us? Is this telling us inflation may be rising? Maybe. And also if you're any type of consumer or have children or going to college or paying any healthcare bills, I'd be hard pressed to say inflation is only at 2%. So again, just looking at what they say everything looks all right. Looking underneath the hood could tell you a different story. And this little hookup, could heading in the wrong direction. If you're a fan of low rates, this may not be a good idea. So rates may be going up from here. It's not a tomorrow story. It's not a monthly story. But again, just looking at this inflation, things start making me nervous that something is going on underneath the hood and we need to pay attention to it. So turning to the yield curve, again, we've all heard about the inversion. Listen to any type of press. Well, that didn't last long. And what we're looking at here is 3 different curves across the US Treasury. So again, it's what you can get by lending to the Treasury for 1 month, 3 months, 6 months, 1 year, 10 year. This dark blue one was 1 year ago. So again, that's what a healthy yield curve should look like. If I lend you money for 30 years, I get more money than if I lend you money for 6 months. A month ago is this lime green, or a fluorescent green line. And what we're looking at right now, the gold line, is where we are now. The first thing to take away is that rates have definitely come down over the past year, and you can see that in this down chart right here. Tremendous lowering rates across the curve. The other takeaway you can see is that it's starting to more normalize here. This curve is very flat, but again, you can still lend 30 at 2.1 and the 2 years only at 1.6. So again, still healthy, but when you start looking at some of these short-term rates, 6 months, 1 year, same amount of interest. Going on to 2 years is less than 1 year. So again, what's that telling us? Something's wrong. It may be moving towards a more normal state, but underneath the hood, there's some divergence going on. So we'll kind of have to see how this plays out. Right now, there's no inversion between the 10 and the 2, so that's not singling a recession or anything like that. But again, looking at the data, something just seems amiss. So moving up the risk scale, looking at corporate fixed income. So again, what we're looking at here is credit spreads. And anytime you hear credit spreads, what you have to think of, it's the interest rate over and above the treasuries. And it makes sense, right? If you think about it, if the government, the US government, is risk-free and I can lend them money at 3%, why would I lend IBM at anything less? There's always a risk premium because IBM could go bankrupt. Our government can't. So I may lend to them at 3.10%. I may lend to them at 4%. That difference is the spread. So how much more interest do I need to give myself to invest in these bonds? That's what spread means. You think about it as a valuation metric, like a PE ratio. So what this chart is telling us in all this data is credit is getting expensive, and it's getting more expensive by the day. And the way to look at this is this investment grade corporate. So these are investment grade corporate bonds right here, and this goes throughout the chart. I'm just using this one as an example. Think about IBM, Apple, Microsoft, companies like that. Over the past 20 years, the average interest rate above US Treasuries has been about 157 basis points. As of 9/30/2019, that spread is at 1.15. So again, trading very rich, and that's across the yield scale. So BB, which are more risky companies, high yield is even riskier. Again, across the board, you see it everywhere. Spreads are tight. And as I'm going to show you in the next few slides and coming up is we're seeing this rise in risk across our risk models, but these credit spreads are signaling just the opposite, right? If they're that tight, they're saying everything's fine, that there's nothing to be worried about. But again, these are the divergences. It means something is off. It could be our model, it could be the credit spreads. Now, giving past history, I'm going to say it's going to be credit spreads because investors tend to get too excited and go to extremes and bid up assets. But we'll have to see what the data tells us. So that's the fixed income world. I'm moving on to equity. And again, another one of our tenets of our philosophy, other than factors, is valuation. What you pay for something matters. So we do think it begins with valuation and price. And what we're looking at here is a historical PE ratio of the S&P 500. It's forward-looking, so that's taking all the analyst estimates, looking out 12 months, putting that in the numerator, the denominator is the price, and taking a ratio. So what this allows us to do is to compare markets in different time frames to see are they expensive or are they cheap. And again, we use standard deviations, which is just deviations from the average. If I get the 25-year average, it's 16.22. So again, you can see that it has been more expensive than it is right now. Back in 2000, it was up at 24, and we're definitely not in that range, but we are above the long-term average. And again, if you kind of look at our preferred valuation measure, CAPE up here, Shiller's PE, that is overvalued too. Dividend yield overvalued, price to book overvalued, just seeing a theme here. It is not outrageous, but it is overvalued. It really was a lot overvalued recently, but again, this is a tax cut. So this is what happens when you cut taxes on corporations and you see this big decline in the actual PE ratio. So it got more attractive from a price perspective. But looking at this longer term, it's still above its long run average, still seeing it a little bit overvalued, a little less so. And again, we start rolling off some of the performance from 2009, the Cape. But again, still indicating that markets are overvalued, so it's tough to get too excited. This doesn't mean that you want to have zero exposure to US equity markets, but I'd be challenged to feel safe putting all my money into US equity markets given the valuation levels we're seeing. How does this translate across the pond? So we're looking at global equity earnings and valuations now. On the left-hand side is earnings. And you can see that the upward and to the right, there's some volatility there, but the US is definitely doing better, but everything's kind of going in the right direction from the crisis. Over here is valuation levels, and we use price to book and price to earnings here to kind of judge where we stand on different asset classes. So the first one's the US, and like we saw in the previous chart, it's a little bit above its average. We look at developed markets, which include the US, and it's pretty much a little bit below average. Europe, almost one times lower, which is good. So again, we like international. Japan, who's kind of beating to its own drummer right here at so cheap. Again, they had some idiosyncratic risks that kind of caused this. And we look at EM, which we really like, and that's trading at a very big discount to its 25-year average history. So again, when we're looking at risk assets, we're not thinking it's the greatest time to be jumping in, but if we want to add to risk assets here, across the ponds, across the Pacific, across the Atlantic is looking a little bit better from an evaluation perspective than the US right here. So again, we still think ex-US is still a little bit more attractive than the US in the risk assets. So turning back to the US, let's see how the corporations are doing. So we're looking at corporate earnings, going back to 99 on the left hand. So this is actually what they earned, and then the ones in green are the estimates. So again, upward and to the right, nice to see that. Looking at profit margins, almost at all-time highs at 11.4, bouncing back nicely. So again, when we're looking at this and we're talking about the headlines, don't tell the whole story, and these are the headline numbers. Earnings are rising and upward to the right, healthy profit margins. Everything should be good with corporations. So what are corporations doing? So if they're in this healthy spot with earnings rising, profit margins at very healthy levels, they should be investing this money. So what are they doing? So what's corporations doing with their money? And this is what the spending is. This is a nice chart from Goldman Sachs, going back to 2015. So again, broken up by how we're using our capital, investing for growth, capital expenditures, R&D. Again, that's investing in the business. You see growth, you want to have a new wind turbine, you want to have a new factory, anything like that that's building out. And these are the actual numbers. I'm more interested in this down here, year-over-year growth. It's the same thing as up here. It's just looking at the growth from a year-to-year basis. So we look at 2018, we saw very heavy growth across the complex. Capital expenditures were up 15%, R&D up 11, cash acquisitions up 34. So again, it seemed like last year corporations were very confident and were investing for the future. We look at what we're expected in 2019. The picture starts to change a little bit. So capital expenditures are growing. They're not shrinking, but only up by 1%. R&D only up by 6%. Cash acquisitions, which are very volatile, again, depending on the marketplace, they're expected to be down. We look at share buybacks, and everybody's talking about share buybacks and supporting the market, and it was up 54% in 2018. We're actually forecasting a downward 15% in 2019. So again, companies aren't buying back their shares. They're not using cash to its full extent. And again, take that in with the last chart where they're almost at record profit margins and earnings are growing at a very healthy clip. Why aren't they spending more? If you take a look at the numbers at face value, they look all right. But as soon as you apply even a little critical analysis like we just did, the picture quickly changes and you start to see cracks in the data. In other words, an increase in risk across financial markets, and maybe the increase in chance of a likelihood of a left-handed tail event. And those are those events in the equity markets that destroy investor wealth. So again, we're just seeing divergences across the financial complex. So we know companies aren't spending the money, even though things look healthy. Why aren't they spending? Well, one reason here is the CEOs aren't confident. And what this is another chart from Goldman Sachs looking at just CEOs. And why do we care about CEOs? Well, they run companies. And what do? They're the ones deciding, should we hire more people? Should we invest in that new growth businesses? Should we buy that new plant? Should we open a new store? Should we invest in our employees? They're the ones deciding it. They're the ones kind of leading the charge. And if you look at this over here, they're not too excited about the future. So even though we're seeing all these strong headline data, the people, CEOs are saying, you know what, they could be the canary in the coal mine saying things don't look too good if I go out next year, 2 years, 3 years from now, and maybe I won't be investing as much. And we're seeing that in the data that we just saw with the use of cash, that they could be holding back a little bit. So this could be that canary in the coal mine. Switching to the economy and looking at some other data, we're looking at the US leading indicators. We don't use this in the model, but it kind of gives you a good sense of where we are in the business cycle. And it's put together by the conference board. It's a subset of all these indicators. I'm not going to go through all of them, but if you look at the headline, again, common theme here, it's a year-over-year positive change, is trending down, so that's not great, but it is still positive. But just looking at this, the short-term, long-term trend, try and looking at colors, right? Green's good, red's bad. I think it's balanced more to the bad with a few neutral in there. So again, looking at the headline data, we're positive, that's good. Looking at the underlying data, trending down and not looking too good when you look at the individual components of it, you see divergences again. What's going on? What is the leading indicators? What's the CEOs seeing that no one else is seeing? And the consumer is definitely not seeing it. So again, that's the strong piece of the economy. We're looking at their balance sheet right here, their assets and liabilities, they're feeling pretty good. Look at the debt to service ratio. Again, so how much we have to pay in debt as a percent of their income at historically low levels. Looking at the net worth, and I know this is not distributed equally. There is a dichotomy in our economy, and that's not for investments. We can talk about that in a separate call. But again, on average, which no one is average, but on the average, household net worth is increasing. So again, the consumer is good. The problem with using the US consumer as any kind of indicator in the economy is that it's what we call a lagging indicator. Again, we talked about the CEOs and why is that important, because they're making the decisions to invest. The consumers are end users of that. So by the time the data reflects a consumer retrenchment, it's too late. It's already inflected in asset prices. So if we wait till this spikes again, if we wait till the net worth starts coming down, if we start waiting till the consumer sales data, which is 3 months lagged, comes in, when we're going to be too late by the time if you're trying to figure out what's going to happen in the future. So again, the consumer, even though you hear all the headlines that they're looking good, they're still strong, they're a lagging indicator. And by the time we see it there, it's too late to do anything about it from a financial asset standpoint. So expanding our horizons, going out to the world, looking at world trade. Again, as you would expect, given the current trade war, the slowing of the economy, all the data we're looking at, you can see that world trade has turned negative. You can see it right here in July 2019, it went negative. And it's continuing to trend negative as we see here. So again, looking at the global tariffs, it's not hard to see why this is going negative, but this does have impact on financial markets. Global trade is a big piece of global growth. If there is no global growth, then you would think global trade would go negative. It's been the big driver of economic and it's been an economic engine driver going over the past 5 to 10 years. And if that starts to slow, you're going to see the economy start to slow. And the one thing we're kind of struggling with and looking at all the time is, definitely happened due to the trade war, but is it transitory? Is this just inventory building before the tariffs took effect and then this is going to snap back? That's the million-dollar question. The data's not looking too good for that. But again, that's something we're looking at. And we turn to the global manufacturing, which again becomes before the trade, right? Because you got to build something before you actually trade it on the most part or build the part. And what we're looking at here is global manufacturing across the world. Again, not going to inundate you with every single number here. But again, I like these charts because it's very easy. Green is good, expansion. Yellow is kind of neutral. And red is, whoa, something bad's happening. Looking at the end data over here, you can definitely start to see red creeping in where it used to be all green. So you're seeing a global slowdown in manufacturing. Again, given the tariffs, given the trade war, given everything that's kind of going on, it's telling you that growth is slowing, that something's going on and we're not sure that we're going to continue to grow at the pace we have in the past. And that may lead to some negative outcomes for individual asset classes. So now we got negative trade, negative global manufacturing. Are we the only ones seeing this? Is it just the financial markets? Is it just the people putting together this data? Well, to answer that question, turn to the IMF. Everybody should know the IMF, International Monetary Fund. Now, in terms of financial asset performance and judging growth, they have no dog in the fight. They don't really care if we grow or not. Now, at individual country level, there's some politics at play, but overall, when they're looking at the world, they don't have a dog in the fight. They don't really care too much if we have negative growth, positive growth. They're just trying to get the best data out there. And what we're looking at here is the most recent one, which was in October 2019. So 2018 is actual growth in the world economy. So the world output was 3.6, not too bad. But the IMF is projecting right now going back down to 3 for 2019, and then bouncing back a little bit in 2020. So again, good growth, that's awesome, we're growing. But looking at the underlying data, if it used to be growing at 3.6, we have healthy corporations creating a lot of earnings, having a lot of money in the balance sheet, a healthy consumer that has a great balance sheet. Why would we expect growth to slow? We should be expecting growth to pick up. So again, it's these divergences that are out there that are telling us something is wrong. And you see it pop up here and there. And I'm going to talk about inequality here a little bit. And it's not to say what's causing it, but just to say that it's going to have an impact. Because we look around and see what's happening. We see this slowing growth, and we see countries reacting to it. Just recently, we saw Lebanon. They put a tax on the WhatsApp. So if you have kids or grandkids, you know what a WhatsApp is. It's an application on your phone, and they taxed it. And there was riots, and they took it back. In Ecuador, they had a fuel price hike. So, they took away some subsidies. And again, what did they see? They saw a riot. Chile, they hiked the cost to get on a bus. You saw protests. Haiti, they had fuel shortages. And don't forget the recent protests, the yellow vest protests we saw across Europe. So you're seeing these things pop up that everything may not be as good as you think it is on the headline. So again, this is a very real and it's a global phenomenon, and it will have an impact across the financial systems. So anytime you look at these headlines, really look at the details to see what it really means, because not everything is as good as the headlines make it out to be right now. Again, looking at the data. So speaking of the data, when we're looking at the risk in the environment, we've kind of looked at the fixed income, the equity, the economy. We kind of look at it through multiple lenses and put it all together in what we call our Stonehearth capital market risk model. Now, those of you who have met with us know what this is. We do use 49 indicators. Some of it is based on this model, and the other one is the Ned Davis Fab 5 model we use, but we're focusing on our internal risk model right here. We have 5 subcomponents. The first 2 are both technical, structure and reversion. And again, when we talk about structure, it's the right parts of the market are performing. Again, the riskier parts are leading the way in a bull market. Reversion, we're looking for inflection points when markets look to turn. We talked about valuation. Like I said, we're a big valuation shop, that we believe that's an underlying driver of what you pay for something is the underlying driver of prices. So we believe in valuation, the macroeconomic data, the data that actually leads. We're looking for the data that's actually giving us some insight into what's going to happen over the next 3, 6, 12 months. And we look at the qualitative data, which is just the years of experience we have at Stonehearth to look at the marketplace. So when we last spoke, 6/30/2019, a little bit after that, we're at a positive 2. Things were looking pretty good. Again, negative valuation, we've been there for a while. And then we look throughout the quarter. July was a very quiet month, not a lot of change, nothing really changed, still a positive 2. August, starting to see a little bit of divergence. No change on the valuation, no change in the economic or the qualitative. Looking at the technical, we did take a hit there, and August was a pretty weak month, and you saw the reversion go to neutral, lose a little bit on the structure, went down to -1, and we talked about this in our investment committee meeting, where this was just more noise than anything else, not really a change to anything underlying data. And we've seen our model kind of fluctuate, -1, +2, -2, +3, -1, and we've been seeing that. And we're seeing that in financial asset performance too. And I think it was last quarter when I came up with, we're really in the waiting place. From the Dr. Seuss book, All the Places You'll Go. Given what we've seen in September when we go through, I do think we're out of the waiting place. We have moved on. And when we look at it right here, we can see the big change is the economic data. It went from a +3 to a -1, which is a delta of 4, which gives you this -5 for a total score of a model. Just to be clear, we're not seeing this in that Ned Davis data yet. They're a little bit less economic sensitive. I do think you will see it there eventually, but they're not seeing it yet. But at least for our data, we saw definitely weakening of economic data that matters to future economic activity. And that's a big thing. Again, we talked about the consumer, right? The lagging indicator. By the time you see it in that data, it's too late. We use indicators that actually foretell what was probably going to happen with economic activity over the near-term future. So again, technical picture, still all right to neutral. Valuation, still negative. The big change was the economic weakness we saw. So what was causing this economic weakness? Employment. What we're looking at here is a 3-month smoothed average of jobs being created. Anything above 0 is good, right? Because you like to be creating jobs. So it seems to be pretty healthy. And again, we didn't change that. That's still positive in our model and fluctuating right around here, which is fine. We don't need this to grow. We just need this not to go down. And so far, so good on the employment. Historically, employment has been a lagging indicator. So again, it tends to react later than others, but we do like it in the model because it gives us a nice balance of what's going on with the consumer. So again, all is well in the employment front. Manufacturing. This is the PMI. This is US PMI. It's a 3-month smoothing average. So again, it hopes to eliminate some of those whipsaws you get with one data point. So what we saw over the past 3 months, you average it out, we're in contraction. So again, above 50 expansion, below 50 in contraction. And this is a survey, it's called the diffusion index. And all of this, it asks purchasing managers across the US, are things getting better, staying the same, getting worse? You add it up on 3 different metrics and you get an output right here. Above 50 expansion, below 50 contraction. And you can see that we just dipped below contraction. So again, driving that weakness in the economic, things that we actually foretell in the future is seeing weak in manufacturing. And to me, not to put one indicator in front of the other, I do like new orders. Again, this is X capital, non-defense capital goods. I mean, defense goods. So we're not talking about purchasing airplanes for the Defense Department or any government purchases. We also exclude aircraft. So when this Boeing thing is going on, it does not affect this number, which a lot of people told me that, well, it has to be Boeing. Boeing's not in this number because it's X aircraft, because aircraft are so lumpy, $1 billion a plane, and that affects this number. What we're looking at here is a year-over-year change of the 3-month average. So our companies actually ordering more long-term goods than they were at this time last year. So take away the seasonality, it eliminates that. It also tells you that long-term goods are supposed to last 5-10 years. So it's a lot of the purchases are if you're confident in the future. Is this increasing or decreasing? Is it positive or negative? And it just hit negative, just barely, negative 0.09. So again, could this bounce back? Yes, it also could go down lower. Taking it all together, looking at it through multiple lenses at a very high valuations across the board in our model, a so-so technical picture, positive qualitative picture was just really that the Fed's going to keep rates for lower, and a deteriorating economic picture, especially the numbers that we think matter to future economic growth. And we do think a change happened in the 3rd quarter, that it is prudent to maybe take a little bit of risk off the table here, given what we're seeing. Again, no guarantee, but the risks are rising. So how we positioned our investors for this? So we look at our asset allocation. This is as of September 2019. So we look at the headline, equities, underweight. And again, talk about the valuation picture. If we were to invest in equities, where we want to invest in, definitely overweight emerging markets. Do like that for the valuation. International developed, still a little bit better valuation picture than the US, but not great. So we're neutral international, underweight US. Fixed income, still underweight, but increasing that. Again, I think it's all right here to kind of add to fixed income, given what we're seeing in the economic data, looking at what our model's telling us, and especially with that, what our model's telling us, you want a healthy allocation to cash, which we do right now, we're overweight cash. And we still like the alternative space. Again, when we look at alternatives, we define that as any financial instrument that is not dependent on the fixed income or equity markets rising to generate a return. So again, markets don't have to rise to generate a return. So now we have managed futures, merger arb, and a total factor fund from BlackRock that invests long and short in factors across investment asset classes. So that's where we stand from asset allocation. And that's kind of want to sum up everything we've kind of talked about here in one picture. And I've struggled with this and I put together things, I've been working on it. And again, like anything in life, usually you can find something out there that someone who's done it better than you already. So I went out and found this from Cantor Fitzgerald, so hat tip to them. They're a global corporation with a $1 billion marketing budget, so I'll give it to them. And this is what they came up with, but I love it. I do think this gives you a sense of what's going on in the world. And we're looking at scales. And again, we always talk about a weight of the evidence approach here at Stonehearth Capital. Is it more tilted towards risk or riskier assets? Where is it tilted? We look at our model. What's the way the evidence telling us? Is it more risky or less risky? And we're looking at the left-hand side. This would be considered risks, negatives. We had the global slowdown. We saw that in the data. China and India. We saw the trade war. We have Brexit coming up. We can't forget about that. It seemed solved for a little bit, but now they're having an election in December, so we'll see what happens there. The monetary policy limitations, we're almost at zero. You can't really go too much lower. U.S. earnings recession, even though we saw it was upward to the right, we are seeing weakness in earnings coming in a little bit. Credit market, we talked about credit spreads. They're very expensive. We still have the impeachment, so don't forget about that. There is a lot of political noise going on. We still have Syria out there that's not solved yet. Comparing that to the positives, we talked about, everybody has a job pretty much. Who wants a job? They may have two out of need, but the jobs are pretty plentiful out there. Again, monetary policy is easy. Oil and gas is cheap, but again, depending on the month and the volatility, it could be expensive next month. Credit market liquidity is pretty good. Again, companies can borrow money fairly cheaply. And corporate buybacks, even though they're decreasing, they still are a big piece of the market. Weighing all that together, we still think it tilts more to the risk, just like this picture is telling us that the risks have increased. It is weighed more to the riskier side, and that reducing risk in clients' portfolio would be a prudent thing to do given what we're seeing. So with that, I'm going to turn it back to Amanda to see if there's any questions out there. While she's doing that, look at the appendix, my compliance, my lawyers, and we'll get to questions and answers.
Hi, Chris. Thanks so much. Just a reminder to everyone, there is a questions section on your GoToMeeting taskbar. You can go ahead and submit your questions there, and I will read them off to Chris as we receive them. The first one we have, Chris, is you seemed somewhat negative in your presentation. Are you going to be taking any action in your portfolio?
Yeah, I guess it did come across pretty negative. Yeah, so we don't really comment on any individual portfolio, and I did mention it a few times here and there. But in general, yes, we did do a risk reduction trade for clients across the board, basically lowering and going more underweight some of the riskier asset classes and going less underweight some of the more traditional fixed income classes, really adding to duration here. So again, yes, the data is telling us to do this. We had an investment committee meeting and we decided that it would be prudent to lower risk in client portfolios. So yes, we did just lower risk a little bit. If anybody has a question in the individual portfolio, please call Jamie or David or Andrew and set up an appointment and we can talk more about it.
Chris, the next question I have here is, I heard the market is expecting a rate cut at the upcoming meeting. What happens if they don't cut?
All hell is going to break loose. World War III. I don't know. We looked at the chart. We saw that the divergence where the market really needs them to low and the Fed says they're going to raise rates. Not this time. They do indicate that they're going to lower rates. But I think you will see dislocations in the marketplace if that happens. So again, that's kind of some of the thought process we're going into why we're going to reduce risk here. Because if you look at the outcome that's most likely, it's just a shrug. The market expects it. Not much is going to happen. So what are the odds of something really blowing off here and then the equity market rising? Not a lot. What's the risk that they make a policy mistake and the markets crash based on them not lowering rates? It's increasing. So again, given that, it's prudent to reduce risk in portfolios given the range of outcomes. So again, there will be violent dislocations across the marketplace if that happens. And I don't think that's going to happen, by the way. I do think they're going to lower rates.
Chris, I think you said the yield curve is not inverted, but it looked like it was on the chart. Can you please explain further?
Sure. Let me see. Let me get back to here. Yield curve, yield curve. Sorry about this. Just a little slow there. Getting the yield curve. Okay. Yeah. So again, we heard a lot about inversion going across, but what they fail to say, again, it's that headline risk where they say, oh, it's inverted. And we're really talking about is the 10s and 2s. So the 10-year and the 2-year, that's what historically has been a good predictor of future economic environments, the 10 and the 2s. That did invert in August for a slight bit, a day or two, and then it re-inversion, so normal. We're still inverted down here, but again, that has no predicted historical value. If you go back in time, we've never been there, so we can't say that because the 1 year is less than the 1 month, that's telling us anything. So the inversion that really tells us or leads us to believe that something bad is going to happen or there's something wrong in the marketplace is really the 10s and the 2s. And that, if you look at it right now, is even though it's flat, it really is not inverted at 10 years and yielding at 1.7. That's up a little bit now. It's actually 1.75 today, and then 2 years at 1.6, and it's a little bit lower. So again, the ones that matter aren't inverted. And yes, there is some inversions on the smaller end, lower end of the curve, but we don't think that is indicating anything other than the fact that when you're this low in rates, little small changes have big impacts on the number. So the data is skewed a little bit. So again, it's a good question. And again, it's why you have to be careful just listening to people talk on TV sometimes, because they don't have enough time to explain what really matters and look underneath the data.
Chris, it looks like we have one more. You mentioned that the weakness in trade, manufacturing, and I think you mentioned it when you were talking about your model. If it is transitory, how will you know and when?
Good question. We'll let the data talk to us, and what we really would look at would be our model, right? So we'll look at our model. We saw the new orders. We'd see that kind of bounce back a little bit. We'd see manufacturing pick up because, again, start ordering more, feeds through the manufacturing base that says, okay, we need to produce more because we're seeing more orders. So we'd see it there first. Again, we don't expect that to happen. We think we're kind of going a little bit lower down here with those. That's where we'd see it first. In terms of when, it really depends on how much the snapback is. We'd see it sooner rather than later if it's a snapback, and then we know when to react, right? So if we see that snapback and we see the data getting better, and we take that in with the technical picture and the valuation picture, and that looks more positive, then we're able to reverse that and maybe add back risk to the portfolios. So again, it should be in the short term, and we're looking really at that economic new orders and PMI manufacturing to bounce back if we're going to see a snapback in that.
Chris, just going back to the yield curve, why would you say more fixed income and add duration when the long-term bonds are paying almost the same as very short-term?
Yes, it depends on what you're using it for. I'm not using it for income. Again, we see risks rise in the marketplace. We think that there's going to be dislocations. When dislocations happen, the Fed lowers rates. Now, they're near zero, but they are at 1.88, so they have room to lower rates. They also are more apt to lower rates, and I think that's something I've changed over the past 6 months, is that the Fed's more easily influenced by maybe the press, maybe tweets, and you can draw your own conclusions on the tweet, that they may be quicker to lower rates. When you lower rates, you get a big pickup in duration. So the higher duration you have, the more protection you have on the downside is kind of where I'm adding to it. And when I look at bonds, we're really looking at the middle of the curve. So we're looking at this 2, 3, and 5 year. That's really not too bad. It's 1.6, 1.5, but has a little bit of duration to give us some of that downside protection. You are right. I wouldn't go out these 30 years and lend at 2.1. I wouldn't lend in the credit markets right now, again, given those tight spreads we're seeing. But lending to the U.S. government, 1.6 with a little bit of duration and the expectation that if something happens, the Fed's going to lower rates and you get that nice boost up in performance from that duration, that we're willing to take that. It's also a function of where we are, right? We're not long duration here. We're very, very short in client portfolios and duration. So adding some here, we're just going a little bit less underweight. It's not like we like bonds. We're not going overweight that duration. We're just going a little bit less underweight than we are right now.
Thanks, Chris. I'm going to just give another minute here in case anybody else has any questions. You can submit those. I do want to just touch base on our next 2 webinars that we have for the end of the year here. We've got one coming up Monday, November 25th at 10 a.m. That's with our Senior Financial Advisor, David Giuliano. He's going to be discussing charitable donations and gifting. And then in December, it's Wednesday, December 18th with our Senior Financial Advisor, Andrew Nadeau, and he's going to be discussing solo 401ks for the self-employed. You can find all of those on our website at www.stonehearthcapital.com. You can sign up for those, and then of course, we'll resume CIO's Corner webinar as we do every quarter with Chris. And it looks like those are all the questions, Chris. So thank you so much for joining us today.
Thank you, and thank you everybody for listening.
All right, have a great day.